Ladies and gentlemen, welcome to the show. Again, my name is Alfred from DiversiFi Capital. It's Dfi-nancial Friday. It's Friday as always. I'm always so excited to be here. I've always got Raymond joining me as well. Raymond, how are you doing?
Doing good, doing good. Have another long weekend ahead of us, and
I
happy
didn't
Lunar New
even
Year.
realize until you said that right now.
You're welcome. You're welcome.
Yeah, yeah. Again, welcome everyone. Welcome to another show of ours here. We've got actually a lot packed on deck for us to be talking about today. As you guys are rolling into the stream here, I'll of course give you a little bit of a market update to tell you a bit about what we are seeing, and then we are going to dive into the world of traded real estate. So things like real estate investment trust or REITs. Why do people even invest in real estate? What are people enamored by? Like, why is it there's some focus always on trying to invest in real estate? We're going to give you our take on it, why our clients, think they want to invest in real estate and why they end up investing in real estate. Sometimes those are a couple different things. But as we get started here, as always, we are going to be talking about a little bit of investing today. So make sure, of course, as we are talking about that, these are just general ideas, right? We're not soliciting you to be buying any investments specifically, but again, asking the right questions about your investment in your investment portfolio so that you can make your own decisions, take that to your own financial planner or professional to make those decisions with you. In regards to, as we talk about tax, we're not acting as your tax professional here, just giving you some general ideas, especially when we're talking about investing in real estate. What are some of the tax benefits that could be there? And of course, in general, right, these shows are for financial education, hoping that we bring a little bit of what we're passionate about to you guys on a weekly basis. But again, not meant to be for specific financial planning. We have a place for that, right? DiversiFiCapital.com. Visit us there, learn more about how, if you're interested in learning more, building up your own financial education there, check us out. Hopefully that's something that you enjoy. All right. Let's start with the market update, right? Let's talk a little bit. Markets continue to do their thing, right? We had another good week here. Raymond, tell us a little bit about what you saw.
Yeah, so this week, in terms of the markets, Dow Jones was the lowest, but they are still up 1% this week. We have S&P 500 next at up 1.23%, and then NASDAQ again just leading the way at 1.73% this week. So market's still climbing. Some of the headlines that we've been seeing is, once again, just things that we talked about, like the stimulus that they're continuing to try to inch towards and hoping for early March to reach a deal there. So that's something that investors are keeping a close eye on. We also had COVID cases drop, right? We saw such a big resurgence during the holidays that now it's been about a month and a half that hospitalization cases are going down, which is definitely a good sign. But that's always going to be something that's lingering for at least this year, and only hopefully for this year.
Yeah.
Doses get distributed.
Yeah, and I think it's more and more people siding towards is the market too frothy, right? Meaning, is it too overvalued? Yeah. I saw an article where something like, because of the Biden administration, people wanting to invest in EVs, right? And so Blink Charging was a company, I think it went up something like 3,000% in the past 8 months with not much fundamental reason for it. And I think that worries people. And certainly it's something that when I look at it is like, sometimes it doesn't make sense, right? But, the market has its own ideas, its own momentum, its own I would say appetite for risk. And I think as we start to see things continue to go up, I think more and more of the camp of worries and overvaluation is going to continue to surface here. And it's going to be interesting about how that battles itself. Look, in any given year, it's rare that the market just goes straight up. It would surprise me, honestly, if we didn't see some 10, 15, 20% correction in any given year, in particular this year where markets last year did so well and things continue to be volatile. I'd be surprised if we didn't see it, right? And it's one of those things where that's why we stay invested for the long run, because you can't time these things. It's just you kind of have to ride your way up as things go so that it prepares yourself when the market adjusts to the downside, right? But the numbers kind of wild, right? It speaks for themselves every week. Generally speaking, when we do these shows, right, Ray? Like those are positive numbers lately. And so
Yeah.
It's pretty incredible to see how the market has run up, especially after the election here.
Yeah, definitely. I mean, it's one of those things where it's good that it's happening, but also want to keep a close eye on it. And, looking at the investments on another item would be cryptocurrency that we see today just soar up to 49,000 there. Right now, I think it's around 48,000, but
Wow.
sure, if some people have heard the news around Elon Musk, will end up putting in $1.5 billion into cryptocurrency. And we all know, even from Elon Musk tweets, how far that can go, right? So
yeah, Dogecoin, right? Didn't he tweet about that? And which is funny because it ties back into our last week's, or maybe the week before show. Last week we were talking about real estate with our team there, but we were talking about these meme stocks. I don't know if any of you've checked it out lately. They're all back down to where they were, back to earth. A lot of fun for a couple weeks there, but my phone has certainly died down a little bit in terms of asking us about should we be trading GameStop or AMC, right? And at some point it's just one of those things where fundamentals don't add up to something like that. Of course, external factors with how Reddit pushed them up and whatnot, completely different storyline we had talked about a couple weeks ago. But just as a follow-up, those stocks have come all the way back down, right? So it's just, again, interesting to see that. Man, I kind of just want to jump into the real estate side, Ray. Like I want to kind of talk about this idea of REITs and traded real estate, and something that I've been part of, and both of us have been part of for a long time, and doing some research in the private funds on real estate. So, today's segment is to talk about, like, of course, like REITs, the title of it, right? Like, what is a REIT, and why do people invest in real estate? I think that's the topic itself. And I want to start, though, before we get into the methods of doing it, like, what is the top reason that you hear, Ray, that someone wants to invest in real estate? Like when clients come to you or friends come to you, what is like the top reason you can name that they want to invest in real estate?
Yeah, I mean, there's so many different ways to invest in real estate now that we'll talk about today. But a lot of times, what we hear is, outside of their own enjoyment, if they're buying property for themselves, it's really the passive income that they're expecting from it, right? Whether it's dividends that they're receiving or some growth within that type of real estate investment. But the passive income, and that's definitely the leverage as well, right? Depending on what type of REIT that we decide to invest in.
But you mentioned passive income, and look, I get it. I get the idea that it's nice to have rent coming in, right? I mean, they see the older generation, maybe like when I was in San Francisco, right? I rented from a family that owned 5 or 6 or 7 or 8 or 9 properties in San Francisco because they bought it so long ago. And when you're younger, you're like, oh, wow, it'd be nice to have those 5 or 6 or 7 or 8 properties. And then you have this idea, like we hear all the time, right? Like, hey, Alfred, I want something that has passive income. I'm like, okay, like, why do we want passive income? Like, oh, it's because we want to be able to be financially independent. I'm like, all right, we'll take that as a yes. Like, you hear these ideas all the time. And I'm going to break it to you guys right here, right? Like, to me, real estate is interesting as an asset for many different reasons. I like real estate, right? But the idea that it generates passive income as a way to invest in real estate, or for some reason that in real estate is less risky than other assets, I think is a complete myth. Right? I know this is not our Mythbusters series anymore, but I just think that that's right, just an aspect of real estate, right, that happens to that you collect rent. But in my opinion, it's not the main reason why someone should be necessarily investing in real estate. We have to think about the asset class in general, right? In fact, when you think about passive income, the hard part isn't how to generate the passive income, right? Like, you can buy so many things that can pay a dividend, pay rent, you just invest in a stock, continues to grow, right? You can distribute that. That's still income. In a way, it's passive. It might not be a steady stream of income, but it's still passive, right?
Mm-hmm.
The hardest part about generating passive income is having the money, having the assets, right? Having earned some, hundreds of thousands or millions of dollars to buy the passive income. And so I think when I, not to dive further of like saying like why passive income is a bad thing, it's just more so like if you have $100,000, that passive income is not going to get you enough maybe to retire, is I guess what I'm getting at, right? And it's more about building up the way that you make money, whether it's a side business, right? Turning your ideas and monetizing that into something that allows you to have assets to then buy other things that generate income. That's just the way that you end up allocating, right? And that part is easy, right? It's the making the money part, unfortunately, is the hard part, which is why when we get back into real estate, what we want to focus on more so is like outside of just the passive income, right? Outside of just the passive income, like why do people or how do people invest in real estate? And what are REITs? Like what are some of the tools that are available, right? But in what we just talked about right now, some of the primary reasons of investing in real estate where it's for passive income, we should change that idea a little bit, okay? And this is how we're going to approach it going forward into the rest of the show. We're going to change it to say, is real estate, just like any other asset class, a good time to invest in right now? Or in any time, in 5 years, for 10 years, right? Because I think of real estate as an asset class, just like I think of US large companies, S&P, right? Large growth companies or value companies as an asset class, right? A sector or a category of certain markets. That's how I think of real estate, right? And if I think that it's a good time to be in a real estate sector, then I think investing in real estate makes sense. So before we jump into REITs and some of these categories that Raymond and I are going to go into, let me give you a statistic here, right? If we talk about real estate sector, publicly traded real estate, and we'll talk about what that is in a second. Over the past 20 years, compared to say, right, the top 1,000 companies in the US or just S&P 500, real estate in the past 20 years tends to be the top performing sector or asset class. But in the last 3 to 5 and 10 year time periods, it has not been, okay? It has not been. And that's just, right, not necessarily talking about individual homes and whatnot, but I'm talking about, right, a combination of real estate across the board, right, as an asset class, right? It was, or I guess is, in the past 20-year trailing period, one of the best performing assets. So I think you have this idea that real estate does well, but again, it does well in different times. And in the last 3, 5, and 10 years, it hasn't been that way. So keep that in mind as we're coming into talking about how you buy real estate. Okay. So there's different types of ways you could trade real estate. Raymond, tell us a little bit about, number one, what is a REIT, and a couple of different types of REITs that you know of.
Yeah. So REIT stands for real estate investment trust. So with that, outside of passive income, a lot of investors also look to the taxation benefit of it, right? So that's something that, depending on the type of REIT that you're investing in, there might be some benefits, especially from what we've seen from the recent Tax Cut and Jobs Act that we saw in 2017.
Yep.
Now, with the different types of REITs, there are going to be private REITs. There's going to be public non-traded REITs, as well as the ETFs, right? So depending on your goal in terms of the exposure for the real estate investment that you want to get into, there are different kinds and different requirements that we need to be aware of in these type of investments.
Yeah. And so what you mentioned there, right? There was, again, public REITs, real estate investment trusts, right? Private real estate investment trust, and public and non-traded real estate investment trust. All of that is slightly different than just buying your own real estate, right? Exactly. And that's why this is talking a little bit more about trading real estate as an investment, because one way to invest in real estate, and we'll talk about it at the end as a summary, you could just go buy your own property, right? Buy an own investment property, which gives you more control, right? But you need a lot more capital upfront to do so. So generally, when our clients are asking us about, getting into REITs, it's more because they have less capital, right? Or at least less capital that they want to put into real estate. And so they just want to say, I want to kind of get exposed to the real estate market here. So how do I do that? So they go ahead and, buy something like a real estate ETF, right? You can buy a real estate ETF. And this real estate ETF basically is like a stock ETF, right? Like if you buy, for example, SPY, which is an ETF that represents the S&P 500, you can buy something like VNQ, which is the Vanguard Real Estate ETF, that inside of it holds a bunch of publicly traded REITs, right? And these REITs, publicly traded REITs, their job, right, their goal is to get money, buy real estate, whether it's to flip them, own them for commercial, like own commercial buildings, collect rent, right? Their business is managing properties, right? And so owning one particular publicly traded REIT, as Raymond said, is like owning one stock. Oh, excuse me. It's like owning one stock. It's like saying I'm owning Apple because I believe in what Apple is doing as a company. Whereas owning a real estate ETF, which holds a bunch of different publicly traded REITs, is like owning SPY, which is the basket of ETFs that owns all these different companies that have the same characteristic. So in that sense, right, it depends on how risky we want to be, right? But if I want to believe specifically in Equinix as a REIT company, I will buy that REIT company and potentially earn, just like any other stock, 35% a year, right? It has its ups and downs, no less risky, as I said before, than any other stock, right? In terms of like the stock market, it's completely correlated to how the markets are moving, right? And so from that standpoint, a publicly traded REIT very much trades like a stock, mostly liquid, right? If you buy the ETF, you're just buying a basket. So you're spreading out a little bit of the risk, but you're still getting exposure to this real estate sector at the end of the day as an asset class, right? So that is one way to do it. Now, the other way is the private side, right? Or the non-traded side. So Ray, can you give us a little sense of what your take is on not the right, like I'm talking about the private and non-traded REITs, like what's some of the differences? What is your take on the pros and cons?
Yeah, so for the non-traded or the private REITs, they're definitely going to be more risky than you would see as an ETF, as Alfred just mentioned, more of a basket of holdings. So within the non-traded REITs or the private REITs, you're really investing in that company. So you also have to want to do your own due diligence in making sure that they have a good track record, or depending on what they are trying to invest in, right? Whether it's commercial, it could be something that they specifically specialize in, right? It could be malls, it could be hospitals, it could be just normal retail places, right? So all these different types of real estate are going to be what a company focuses on. Now, with these private or non-traded REITs, there are going to be some suitability, at least for the non-traded side, where you need to have, there's a larger amount that you need to invest, right? So it's not something where you can just buy an ETF, maybe put $100 in there. Usually what we've seen from non-traded REITs is something around, a minimum of $15,000, $20,000, $25,000. You must also be an accredited investor, meaning you must meet a certain net worth or have a certain amount of income throughout the year, because in their eyes, this is an investment that is risky and it's going to be illiquid, right? You can't just sell it like an ETF and get those funds back. Once you put that investment in there, you're basically going to have to wait until that company gets acquired or they do a liquidation event, which could be years down the road. So that's money that's going to be locked into this type of investment where, yes, you'll receive dividends throughout the year, but in terms of your principal or the capital that you put in there, that might be locked in, which is where that suitability comes into play, right? So, from an advisor point of view, helping clients in this type of investments, we want to make sure that those type of assets are something that is not needed for the short term. So at least for non-traded and private REITs here, from our eyes, this can definitely be more risky and definitely needs to be more specific to the client and making sure that they understand the risk involved.
Yeah, and you speak more to that, and like I said, I made a comparison earlier about how, like, VNQ, the real estate ETF, right, is like SPY, right? So in this case, like, private or not like public non-traded REITs where they're illiquid is kind of like investing in a company before they go public, right? Which a lot of people like to do because, right, they like the idea where if it can go IPO, right, like if it can go do an initial public offering, there could be this huge jump in share price. But think about how many IPOs that don't make it, right? Now, in this case, on a private or non-traded REIT, there are some underlying assets that they are buying, so there's some value there. But still, the risk is there, right? The risk of the idea that it's illiquid. I think on average, a lot of these REITs take about somewhere 5 to 8 years before they go liquid and fully return the money back to the investor. That's a long time.
Yes.
It's a long time to say, ooh, like I believe in this and thus, I want to invest in it, but so much can happen within those 8 years. And it's also really hard to value these funds, just like it's very hard to value a startup tech company, right? I mean, it's something that, is very complex and may not be very accurate, or the valuations themselves may take a lot of time. I mean, they might go, 12 to 18 months from evaluating a company, right? So, I always ask the question, like, is it worth for a client or somebody to invest in a private, REIT or non-traded REIT versus something that's more liquid? And I think my answer usually boils down to this, right? Which is, if you know who this like fund manager or person who's running this real estate fund really well, and this person is a genius, right? Like, exactly what their strategy is. You fully believe in the strategy and understand that whatever you put in here cannot be touched for a long time, then I think there could be some reason to do so, right? Because there are a lot of brilliant people out there marketing, not just marketing, but like making these funds and gathering ways to deploy their real estate strategy. But it's not something that you would go into it without due diligence. Like, it's very hard for you to say, here's this, right, private REIT that showed up on my desk. Let me go put 50,000 into it. I don't know who it is. Even if I do the research, there's so many of the same type of funds. You have to be really careful, I think, from a due diligence perspective when you invest in these private REITs, right? Whereas for traded real estate, if I just want to get similar exposure for someone, by the way, a lot of these private REITs that do, or non-traded REITs that end up going public, right? It's like they made that next leap, right? It's one of the ways that a non-traded REIT or private REIT can gain liquidity is to go public. You can then just buy the public version of it, right? And get exposure to it and still likely do fairly well in the same sector. At some point I did an analysis and I looked at what if a client just invested in these public REITs through VNQ versus buying some of these private non-traded ones. And in a lot of cases, right, the public traded index did better, right? Because one, it's lower fees, right? It's easier to access, and the performance was either equally or better in most cases. Sometimes it's hard to justify losing out on that liquidity, the unsure time frame of when I have to get it back. So if you do and are interested in private REITs, you have to really, really do your due diligence, not to mention the fees inside of a private or non-traded public REIT are usually much higher, right, than the side of publicly traded ones. Now, I'm going to give you some additional options to think about, right? Like in the public in the public non-traded and the private REIT side, there are some options that have come up lately that I think are really interesting, right? Like in many cases, we actually try to look for a lot of the tech disruptors, Raymond, right? In certain areas, whether it's tech disruptors in life insurance, because it makes it easier to get underwritten, right? For us personally, like who's the best payroll company with the best app? Like integrating that technology is huge, right? And so a lot of companies in the past 5-10 years have tried to revamp the way that you can get access to some of these private equity funds, whether it's through crowdsourcing, like some of you have seen, like you can get into these websites, look at different projects that someone is wanting to invest in, like a home flip, and you can put in $10,000 to those projects. I think those are interesting, but again, right, you have to be very aware of your due diligence. Something like Fundrise, right, is creates their own proprietary REITs that you can't really get access to otherwise. Their fees are reasonable. It's still, I think once you put it all in, it's about 1% fees that is built into there. But that's one way to get access to private REITs that is a little bit better from a fee structure than traditional rounds of just going directly to the company. What was another one? I think it was like Realty Mogul was another one. CrowdStreet was another one. So a lot of these are popping up to give people more of an ability to access private, right, real estate equity. It's kind of very similar to how there's more and more avenues coming up for someone to get access to like pre-IPO tech companies. And so there's an industry out there for that, right? You should go check it out just to see if it's something that you're interested in, if that's the way that you want to go. And again, by going through some of those sites, right, you'll see that you don't necessarily need $100,000 necessarily for one project. They also allow you to break down, right, how much capital you put in, but it's just another interesting way to look at investing in private equity itself, right? And so we didn't jump too much into the tax side, but you did mention, right, in some of the ability to invest in REITs, right? What was, right, one of the deductions that you get in terms of the income, right? I think you mentioned something like that in the Tax Cuts and Jobs Act.
Yeah, so there's one with the qualified business income. So if you're actually investing through any type of REIT, any of the dividends that you receive that's considered ordinary income on your taxes, you may be able to be eligible for a 20% deduction from that amount, right?
Yep.
So it could be any REIT, and usually what is considered a REIT is as long as they're making 90% of their profits, putting back into dividends to their investors, with a few other requirements. But yeah, that is something to look out for when you're doing taxes, is just ensuring that if you did invest in certain REITs, to look out for that possible deduction for yourself.
Yeah, and I think you'll see, right, that the tax that often gets brought up about REITs, and again, it's good to note that from the Tax Cut and Jobs Act, I think it's 2017, right, applied in 2018, but you know, there are some benefits, right, of how those income distributions happen. And in a REIT, in most cases, most of the distribution, like dividends that come to you, can be broken down into three pieces. Like most of it, in fact, like about 80% of it is usually ordinary income. Some of it is capital gain, and then some of it is returning just money to you. Okay, that portion isn't taxed, the returning money to you. The capital gain is taxed like capital gains, right? And then the ordinary income is what Raymond said there in terms of could get some qualified business income deduction, right, of 20%, right, if it properly qualifies. So that's something you want to check with your tax professional. But again, do you do it because of the tax reasons? In most cases, for anything that we do, we don't really do anything just because of the tax reason. If you look at last year, just as a comparison, VNQ, I think, was like in 2020, was minus 7.6% for the year. Didn't do very well last year. In fact, it trailed most S&P sectors last year in terms of like post-pandemic recovery. Even the financial sector that got hit like the hardest during the pandemic, it recovered to pre-pandemic levels faster than real estate, right? And so when you think about it as an asset class, right, it was a tough one to invest in last year, but maybe it's time to get back in, right? It's one of those things where you think of like, is it now time to get back into real estate? But as a comparison, where real estate did minus 7.6 on the traded index, NASDAQ did something like 44%. So even if I got fully taxed on that, if I got taxed on the whole thing, 50%, give me the highest tax, I'm still at 22% return versus a tax, you know, maybe something that was more tax efficient, but it was still minus 7.6. So focus on the asset, focus on the asset class itself rather than just the taxes. All right. We'll run up against time here. There's so much to talk about real estate. Maybe we'll jump on again sometime to talk more about this, as it's been a popular one lately in thinking about different REITs, right? But I wanted to give you a summary before we end it here, right? Which is, if I'm in a certain category, what type of real estate maybe I should think about? So I mean, first, if you're interested in real estate and you have capital, enough capital, you should first consider thinking about, should you be buying your own individual property, right? Individual investment property, because you have more control of it. Yes, it's more capital intensive, but it's something that you have full ability to see. You can rent it out to whoever you want to, right? Like making sure that it's well cared for, right? That's all under your control. It's also under your control about when you want to sell it. So the liquidity is up to you. Not that you should sell it within a year, but if it's 5 years you want to sell it, if it's 7 years or 10 years, you have full control. Now, if you don't have as much of the capital, but you want to get exposure to real estate, then traded real estate via VNQ, like I said, with the real estate ETF, many other real estate ETFs out there, by the way, right? Those are ways to get exposure to baskets of publicly traded REITs. If you want to be more specific in it, if you know there's some publicly traded REITs that you're really interested in, think of it as picking one individual stock, right? I'm investing in this one company because I believe in the way their strategy is. You can pick that, but it's like picking any other individual stock. And then going from there, if you want to be more risky, if you know, right, if you're good at your own due diligence, right, you're very familiar with the industry, you're good at your own due diligence, you want to do your own research, then picking up a private, right, REIT or a non-traded REIT could make sense, but it's a very particular part of the market that your money is now locked up. It could be higher fees. So you better bet your understanding of these things should be quite strong before you get into it. All right. I think that covers it. Man, that was a lot.
Yeah.
Yeah, I enjoyed talking about it. Raymond, thank you again for joining us on the show. As a reminder, we're on every single Friday here at 3 p.m. talking about questions that we're getting every week and sharing that with you guys over on our show. Let us know in the comments and give us any feedback that you guys are looking for, any topics that you're interested in. We'd be happy to put that back on the show. But otherwise, I hope you guys have a great Friday. Thank you, Raymond.
Thanks, Alfred. See everyone later.
See ya.